All right, let's talk about what's got the financial world buzzing. Federal Reserve Chair Jerome Powell just took the stage and dropped a huge hint about where interest rates are headed. So we're going to break down what he said, why it matters, and what it all means for the markets.
So where does this all start? Picture this: Jackson Hole, Wyoming. Every year, the world's most powerful central bankers get together for this big economic symposium. And let me tell you, this is not just any conference. A few words spoken here can literally move trillions of dollars around the globe.
And right out of the gate, Fed Chair Jerome Powell lays out the core problem. He paints this picture of a massive tug-of-war. On one side, you've got the risk of prices getting too high. On the other, the growing danger of people losing their jobs. His words, a challenging situation. Yeah, you could say that.
And how did the market react? Oh, they heard exactly what they wanted to hear. The Dow Jones just exploded, rocketing up over 685 points. That's its first record high of the entire year. Talk about a massive vote of confidence.
So what's the big takeaway here? At the end of the day, Powell basically gave the markets the green light they were desperately hoping for. He signaled that the Fed is getting ready to start cutting interest rates. And that's a big deal. It makes money cheaper to borrow, and it's meant to kickstart the economy.
Now, you're going to hear this word a lot, dovish. So what does that even mean? Well, think of it this way. When a central banker goes dovish, it means they're more worried about jobs and growth than they are about inflation. It's code for easier, cheaper money is probably coming.
Okay, but here's where it gets tricky. This whole dovish signal puts the Fed in a really tough spot. See, the Fed has two main jobs. It's what they call their dual mandate. One is to keep prices stable. The other is to get as many people employed as possible. And right now, those two goals are pulling in completely opposite directions.
And you know, listening to his speech, Powell pretty much tipped his hand. He showed us which side of that balancing act he's leaning towards. Yeah, he admitted inflation is still stubbornly high, but he spent way more time talking about the risks to the job market, describing it as this fragile thing that could break at any moment.
And this isn't just a gut feeling he has. Look at the numbers. They're pretty eye-opening. We've gone from adding about 168,000 jobs a month to just 35,000. That is a massive slowdown, and it's exactly why Powell is sounding the alarm.
You can probably guess what happened next. The markets just went wild. It was like a switch was flipped, and the party was back on. All those trades that do well when money is cheap, like the whole AI craze, they came roaring back to life.
And if you want to see just how big of a deal this was, check this out. Before Powell even opened his mouth, traders thought there was a 72% chance of a rate cut in September. Pretty likely, right? Well, after he spoke, that shot up to 84%. The market went from "it'll probably happen" to "it's basically a done deal."
And we're not just talking about a few big stocks here. No way. This was a full-blown, across-the-board rally. You had the Dow hitting a new record, smaller companies surging, and the cost for businesses to borrow money falling to a 25-year low. Everybody was celebrating.
What's so fascinating about all this is that it's the complete opposite of what the Fed is supposed to do, right? You've probably heard that old saying from a former Fed chair, William McKesney Martin. He said, the Fed's job is to be the chaperone, the one who takes away the punch bowl right when the party starts getting good. But right now, with the market party already in full swing, it feels like the Fed is grabbing the ladle, not to take the punch bowl away, but to spike it with something a little extra. They're pouring fuel on an already raging fire.
Okay, so the market is popping champagne corks. But, and there's always a but, isn't there? If you actually read the fine print of Powell's speech, things get a little murkier. Not everyone is so sure a rate cut is a slam dunk.
Which leads to the million-dollar question that the more careful folks are asking. Just how locked in is this plan? Are these cuts really a sure thing?
Well, that's the thing. Powell was super careful with his words. As Nicole Goodkind from Barron's put it, he was intentionally vague. He gave a signal, not a promise. And he totally dodged the biggest questions. How many cuts are we talking about, and how soon? In fact, he basically left himself a bunch of escape hatches. He kept saying that policy is not on a preset course. And he pointed to a few wild cards, like tariffs pushing prices up, not to mention all the political heat he's getting from the White House. All of that makes the decision way more complicated.
So, if it's not a done deal, what should we all be looking for between now and that next big Fed meeting in September? Well, it all boils down to one thing: the data. The numbers are going to tell the story. Yep, there are three really big reports to keep your eyes on. First up is the August jobs report. If it looks weak, that makes the case for a cut. If it's strong,
Powell can breathe easy and wait. Next, inflation. If prices are still high, cutting rates gets really, really tricky. And finally, consumer spending. If you and I stop buying stuff, the pressure on the Fed to do something gets intense.
And all of this brings us back to the ultimate challenge, the incredible tightrope walk that Jerome Powell is on right now. The big question is, can he actually thread this needle? Can he cut rates just enough to save jobs without unleashing the inflation monster? The next few months of data will give us the answer.